There are some popular schemes for investment in India like fixed deposits, the post office savings schemes like NSC, PPF, Sukanya Samriddhi has gained prominence, equity mutual funds have gained a lot of interest, and now people are slowly shifting to investing in stocks as well. So often we want to compare and see where to get in. And especially for people who have not started their investment journey, they don't know which instrument to start with or what are the pros and cons. So in this series, I've tried to compare these investment avenues across various parameters. On one side, I've stacked the popular investment avenues, and on the other side, I've put the parameters and tried to give some depth into that. So today we'll talk about the risk and returns of these popular investment options. So let's start with fixed deposits. In fixed deposits, the risk is low. This is because the bank takes our money and then they give it as a vast number of loans, typically retail loans like home loans, car loans, etc. Hence, the risk is diversified. It's also that they give a guarantee of up to 5 lakhs for the fixed deposits. This guarantee is given by most of the public sector banks and private sector banks. Next comes the debt funds, which are short-term debt funds. These also, the risk is low because there is the money that we give the mutual fund, they take it and lend it further. Typically, they lend to AAA corporates or to the government. But there is a chance that some of our principal could get blocked. Hence, I mentioned the risk as moderate here. Then comes the equity tax saver fund as well as the equity mutual funds. These are a little more risky in nature because they are linked to the market. In the short term especially, they can be quite volatile, but as time passes and we stay invested for long, the volatility goes out and the returns become more stable. Then comes the stock market. By investing in the stock market, especially if you're doing it yourself, the risk is quite high. You should know when to buy and when to sell. And most of us are not experts in analyzing companies or understanding the market movements. So the risk is quite high at any point of time. Now, the post office savings schemes which are backed by the government. So you have the NSC National Savings Certificate, the Sukanya Samriddhi scheme for girl children, the PPF, that is Public Provident Fund, and NPS, the National Pension Scheme. Here all these are backed by the government. The NSC, Sukanya Samriddhi and PPF, the risk is very low because, as I said, these are backed by the government. In NPS, there is a choice. You can invest in debt instruments or in debt plus equity instruments. Therefore, the risk goes up and I would term the risk as moderate. When it comes to returns, I'd like to highlight 3 aspects of the returns. One is the type of returns that we can get. Second is the scale of returns relatively, how they stack up against each other, and the range of returns. Do remember that the range of returns is taken as on this point of time. Over time, this could vary. So, the first is the type of return, whether it's fixed or variable. When we get a fixed return, we are quite comfortable with that. There's a general lessening of anxiety here. So, only fixed deposits and the NSC offer us fixed returns for the period that we are invested in. The others all are variable in nature. Now, when I say that the Sukanya Samriddhi scheme or the PPF scheme is variable in nature, what I mean to say is that today, if Sukanya Samriddhi is offering 7.6%, that is for this year. Next year, the government could reset this and offer a higher or a lower rate on this. Same thing for the PPF. In that sense, the nature of returns is variable. When I talk about the scale of returns, that is relative to each other, how do they perform, and the range of returns that each of these instruments can offer, then if we look at fixed deposits, is among the lower returns that is there. So it could generate between 3% to 6.5% at this point of time. The return on short-term debt funds is also similar. They return about 4% to about 8% at this point of time. Market-linked instruments such as equity mutual funds have a possibility of giving us double or more of an FD. So here the possibility of return is about 10 to 15%. The tax saver mutual funds are typically placed in safer investments, less risk is taken, hence the return is lower compared to broad-based equity mutual funds. So here we can consider about 10 to 12%. The possibility of returns, of high returns, is good in stock markets. So I've taken a range of 15 to 25%. Of course, the possibility of low returns is also high, and we could also score about 25%. Among the post office savings schemes, the NSE has the lower returns, that is about 6.5% at this point of time. Sukanya Samriddhi returns are moderate, they offer about 7.6% at this point of time. And the PPF has a slightly lower rate, it's 7.1%. And for the NPS, we can say that depending on if you choose only debt or between debt to equity instruments, the return could be anywhere between 8 to 10 or 11%. So this is how the risk versus return stack up for each of these instruments. As you can see, typically the risk and return go hand in hand. However, we have to also see whether the type of risk suits us and then only invest in these products. We'll be comparing more such parameters in the coming videos, so do stay tuned.